later on in income statement. Okay, so let's take a look at the transactions. Accounting for sales transactions. Here's a case of cash sales. Okay, so in case that you're selling items to customer, let's say they're worth $3,000, and we're collecting cash immediately. Right then and there, once this transaction happens, we gave the goods to customer, we collect $3,000 of cash. These will be the two transactions captured. Okay, the first transaction here increases cash, increases sales revenue, $3,000, is the retail price. And the cost, if we match up with the original amount of the goods that we purchased from our vendor, from our supplier, let's say those goods, earlier we just used $1,900 to purchase it from our supplier. So this transaction here you can immediately identify just by this sales event. You're getting $3,000 cash from customer, but the original amount of the goods, the money that you used to purchase it was only $1,900. So just by this transaction, you're gaining a difference that is how much? The $3,000 is the retail price, $1,900 is the original cost that you used to purchase the item. Then the differences here will be the $1,100, right? So this $1,100 will be the first. This happens January 1st, the first entry. This $1,100 will be the first gross profit gain based on this sales event. Okay, so the first entry is the retail price, the price that you're getting from customer. Second entry was the original cost that you used to purchase from your vendor, from your supplier. The company is trying to gain the differences between these two. So again, on Monday I covered that there are two types of inventory systems, and we're focusing on perpetual inventory system, remember? If we link this to, let's say, a grocery store, the customer comes, they have 10 items in their carts. Once you ring each and every item, the cashier rings each and every item with a barcode, inventory account, cost of goods sold will be immediately affected. Okay, so this is the entry that we were talking about earlier. Once the barcodes has been scanned by the optical scanning machine, the registers, then the second entry here, inventory level, will be updated. Sales revenue would also be updated. Okay, perpetual system, all these transactions actually will be done automatically and on a continuous basis. So once a customer comes to check out the items, these inventory level will be updated immediately. Now what would happen in the case of selling items on account then? This is a cash entry. What would be the difference here if we're selling on account? What would you change? Switch cash to accounts receivable, and anything else? Inventory will still be affected, right? Because if we are selling something on accounts, the only difference is that we're not getting cash immediately, we're getting cash later on, but we are providing the goods, which is why it qualifies as sales revenue, right? Remember the revenue recognition principle? Once we provide the goods and services, it's considered sales revenue, it's considered service revenue. So there will only be one account that's different from cash transaction. We're just switching cash to accounts receivable, we still have two transactions. Okay, so keep in mind that always when a problem tells you or in a situation of selling items, it always affects two transactions, because one would capture the retail price, the cash you're getting from your customer. One would capture the original cost. So there will always be two transactions for sales, no exception to this. Okay, because at the end we want to summarize this dollar amount to figure out the profit in between. All right, now cost of goods sold account I briefly mentioned on Monday. Cost of goods sold is basically the expense for inventory. Okay, so it only captures the expense for inventory asset accounts. So it links to this account Very similar to how we talked about, remember in Chapter 3, prepaid expenses. And then you have possibly insurance expense, where supplies asset account, and when you use it out, it turns into supplies expense account. So it's similar to that idea of your inventory. Once we purchase it in, if it's sitting in our warehouse, it's considered asset to us. So then once we sell it to our customer, it turns into cost of goods sold expense. You ship it out, it goes into customers' hands, it's no longer in your warehouse, then it goes into expense account. Okay, so this is what this transaction is about. Originally, you have this $2,900 of inventory in your warehouse once you purchase it in from your vendor. And then when you resell it to your target customer, that $2,900 originally was on the debit side. Now you credit it, and then you turn it into cost of goods sold. So this $2,900 here is this entry. Okay, inventory asset, we turn it into cost of goods sold expense account once we sell the item.